To understand the process of economic integration, it's good to have a historical background for context. After the Second World War, and in a sense as a response to it, borders started to matter less and less. Many believed that if countries were economically integrated and became wealthier together, they'd be less likely to go to war. 2 years after the war, the General Agreement on Tariffs and Trade was created, which was an international agreement that strived towards reducing protectionist barriers between countries. Reducing barriers to trade, and therefore spreading free trade, is the 20th century setting where all of this economic integration is taking place. Economic integration occurs when two or more economies, think national economies, become more like one economy. That is to say, they reduce legal barriers to trade across borders, which allow for the freer and less costly movement of goods and services, as well as factors of production, internationally. The process of economic integration, in part, ushered in the world of today, where many of the objects we use every day are made up of parts from all over the world and assembled with the collective work of thousands who have never met. The GATT became the WTO in 1995, which continued its role in pushing for freer trade and also acted as a referee in trade disputes between member countries. Member countries are officially considered equal, and the WTO is not supposed to favor any country or group of countries over any other, but that might not be realistic. The US and EU are the biggest agricultural subsidizers in the world, even though the WTO, and free trade advocates generally, would argue that these rich countries have a comparative advantage in more capital-intensive production. At the same time, the WTO might turn around and tell a developing country that it should stick to extracting minerals and avoid protectionist policies because that would be in accordance with free trade principles. So, countries are, for the most part, getting rid of protectionist barriers. A lot of this is happening on a regional basis and is creating trading blocs, groups of countries that enter into agreements with each other where they take away barriers to trade and also barriers to investment and migration across borders. The kind of bloc that is the least economically integrated is a free trade area, like NAFTA, renamed the USMCA, between the US, Canada, and Mexico. This agreement eliminates tariffs or any kind of trade barrier between these three countries, thus allowing the free movement of goods and services across borders. Next is a customs union, which has the free movement of goods and services, plus a common external tariff, which means all members of the bloc, while they have no tariffs with each other, they must share an identical trade agreements with all countries outside of the bloc. Mercosur in South America is a customs union, which means Brazil and Argentina cannot have tariffs between each other and must also have the same trade agreement with all other countries, or other blocs outside of Mercosur. Mexico and the US can have any trade deal it wants with Japan or the EU, but Argentina has to have the same deal with Japan or the EU that Brazil or any other member of Mercosur does. This also means Japan or the EU can't just make a deal with only Brazil, it has to make a deal with Mercosur as a whole. Then there's a common market, which has the attributes of the previous two, plus it allows for the free movement of capital and labor, or money and people. In the EU, it's legally as easy for a German to get a job in Spain as a Spanish person, or for a French firm to invest in Italy as an Italian firm. Pursuing economic integration by breaking off into regional blocs influences trade patterns in a kind of paradoxical way. Imagine the UK is considering rejoining the EU, which is a common market with a common external tariff. Let's also say they do not import any lamb. British consumers only consume British lamb. Joining the EU would mean importing lamb from Ireland in the EU, as the British market would be opened up to them. Price goes down for consumers, and more can now be consumed, and economic welfare increases. This is called trade creation, as we are moving from a high-cost producer, the UK, to a low-cost producer, the EU. But, since the EU has a common external tariff, there's also something called trade diversion, where since the UK is entering a bloc, this prevents them from purchasing from an even lower-cost producer, which in this market for lamb is New Zealand. Since economic integration is happening in blocks, instead of just integrating all economies at once, there is both trade creation and trade diversion. It's like going only halfway. If the UK just dropped trade barriers with New Zealand, UK consumers would have even cheaper lamb, and more of it, increasing economic welfare in this market, and even more than joining the EU would have. There is another level of even deeper economic integration, the monetary union. Most countries in the EU, but not all, share a currency, the euro. Sharing a currency takes away yet another barrier to trade, as there's no transaction costs, and using the same currency makes cross-border transactions even more frictionless. Sharing a currency, however, also means sharing one monetary policy, creating the one-size-fits-all problem. Let's say Germany is concerned about inflation, while Greece cares about reducing unemployment. That means Germany wants high interest rates and Greece wants low interest rates, but since they share a currency, and therefore one central bank, they can't each go in their own direction. This problem is made more acute since the Eurozone is a monetary union but not a fiscal union, meaning there aren't fiscal transfers between countries. California and Mississippi share a currency too, the US dollar, but they also have divergent needs. Let's say California's in the position of Germany and Mississippi's in the position of Greece. But since these two states are in the United States, federal taxes are taken from California will find their way to Mississippi, reducing unemployment there. As countries become more economically integrated, they trade with each other more. That means firms within the countries that are binding themselves together can sell more to more people, which means they can increase output, which means they can achieve economies of scale. This drives down unit costs, which means prices can come down, benefiting consumers, increasing economic welfare through increased efficiency. Increasing sales in other countries is good for some firms, but it means other firms in other countries are going to go out of business. If entering into a bloc makes a country uncompetitive in a particular industry, they might experience structural unemployment, which might be difficult to overcome. Allowing the free movement of factors of production allows for more allocative efficiency. If investment and movement of workers is made easier, capital and labor can be employed in a more optimal way, which pushes out the productive capacity of the economy and increases the long-run trend rate of growth. However, the fact that this is being done in regional blocks, as opposed to just getting rid of barriers altogether, globally, means trade diversion is taking place, and further efficiency gains are being ignored. Romania isn't going to get a good trade deal negotiating one-on-one with a large economy like Japan or the United States, but if it's in the EU, it might. Joining a supranational organization means giving up some national sovereignty. Romania voluntarily limited what it could choose to do when it entered the EU, but also put itself in a better position globally, giving it other capabilities. Sometimes it isn't best to think in terms of countries, however. Which stakeholders benefit from increased economic integration? The answer might be large multinational corporations who benefit from the fact that they can move money and operations around borders more easily, while national institutions and people, for the most part, tend to stay put. This means big companies can more easily threaten national governments with setting up shop in other countries, seeking out lower costs or lower corporate tax rates. This constrains countries and puts them into a race to the bottom, where they feel like they have to give multinationals whatever they want to attract them or hold on to them.